Okay, welcome back to Accounting 101. We're going to be talking today mostly about Chapter 2, a little bit overlap from Chapter 1, and work through this thing. And then the next video will be going over the assignments from Chapter 1 and 2 that can be found in the syllabus. The other day I sent an email out. I actually had to send two emails out because I attached the same file twice on the original one. So you only got two of the three items I had sent. One of the items is a paper that looks like this. Is called the chart of accounts. I didn't write it in there. You might want to take a marker, a pen, and say chart of accounts. And I'm providing this to you to get you familiar with the name of the accounts, the more popular accounts we're going to be encountering this semester. You can actually call an account anything you want to call it, but again, accountants being reasonable, rational, logical people, we tend to give names to things that are to accounts that are somewhat indicative of what the thing is and what it does. And hopefully you'll see that and you'll get a feel for it. And there's slight variations of these things from time to time. But again, these are pretty much standard ones. If you notice, it's organized with the assets first, followed by the liabilities, followed by the stockholders' equity accounts, followed by the revenue accounts, and then the expense accounts. The coding system down the left-hand column, you'll notice all the accounts begin with the digit 1. All liability accounts begin with the digit 2. All the equity accounts begin with the digit 3. And keep in mind that dividends will be shown as a stockholders' equity account, but it's a contra or negative stockholders' equity account. Okay. Revenue accounts begin with the digit 4. Expenses begin with the digit 5. This again is a very simple, rudimentary chart of accounts. I've seen chart of accounts that run, pages and pages and pages, depending on the size of the company. For instance, let's take payroll expense or salaries and wages expense. I have here, account 511. Okay, 5 tells me it's an expense account. 11 tells me it's salaries and wages, or wages and salaries. If I was a medium-sized company and I had a plant in Pennsylvania and a plant in New Jersey, I could have account 511 PA for the Pennsylvania plant. I could have an account 511 NJ for the New Jersey plant. Also, building on that, I could have 511 PA1, 511 PA2, 511 PA3. That would be for the first 1, 2, and 3 would be for first, second, and third shifts. I could then have a P511 PA1 OT for overtime, and for overtime for shift 1, overtime for shift 2, overtime, so on and so forth. That way, management, not so much for financial accounting purposes, for managerial purposes, management could go into the, again, computerized system and sort and look at payroll variances between shifts versus production, how much you're spending on overtime. Why would you want to do that? I'll give you a personal example. Back in my prior career, I did analysis of nursing salaries down at Norristown State Hospital. And I had a little computer program from my MBA program, and I used that because I looked at labor as a commodity. I used the software package I had for the optimal order, so how much you should have, how much you should order. And I was able to run some figures, and again, there was a nursing shortage. This is back in the 1990s, before most of you were born. And the state had the same problems that hospitals had. There was a shortage of nurses. So at the time, our nurses were being paid somewhere in the $40,000 to $45,000 range base pay. And we had nurses that were pulling over $100,000, some of them as high as $120,000, $125,000 because of overtime. You work your 37 and a half hours, and above that you get time and a half, and then you hit another threshold, it goes to double time, and then you hit another threshold, and or weekends or holidays, you get triple time. And so I was able to do an analysis, and I forget, it was either hire 4 or 5 more nurses and you would save $2 million over what they were paying to the existing nursing crew with the overtime. And that's including benefits for the new hires. And we also set the recommendation up that it would improve the quality of care. Think about it. If you're in a hospital, do you want somebody that is in their 90th or 100th hour of work that week to be sticking needles in your arms and giving you injections of medications? Yeah, it's going to cut down on the number of mistakes. So again, the chart of accounts, I have it there listed, that always runs in order. This is sort of like the legend that governs the general ledger. These accounts each one of these would be a page in the general ledger, and they would be in order by account, name, and number. I forgot to throw this out. Back in my prior career, I did encounter a number of different accounting systems at different places. I forget the name of which one it was, but there was one that had the account code or account number was a combination of 36 or 37, I'm sorry, 36 or 38 different alphanumeric characters. But regardless of that, all the asset accounts began with 1. All the liabilities accounts begin with the digit 2, so on and so forth, according to the chart of accounts. And again, if the company it wasn't that big of a company that needed that much sophisticated of an accounting system for their chart of accounts, so they just backfilled all the other ones that they didn't need with zeros, or I'm pretty sure they use zeros or 9s. I think 9s. Computer people use 9 as the unidentifiable thing. All right, so take a look at that. Spend some time looking at it. And again, the big thing is that it's arranged in order. Okay, assets, liabilities, stockholders' equity, revenues, and expenses. And again, just to get you familiar with the names of the more common accounts we're going to be encountering. The second and third things I sent you on the first email was just a sheet with a lot of big T's on it. These are T accounts. Send them out to help you follow through in the book if you want to do it by hand, as opposed to reading and do it alongside with your reading. Some people's brain works that way. It slows the brain down from reading to writing it out. And basically, in real life, each we have 3, 6, 9, 12, 15. So it would be 15 different separate pages in a general ledger. The safe paper, I do them all in one. We're going to put names on these shortly, and we're going to keep the same order as the chart of accounts is designed. And the chart of account book, you can always insert, and again, with the numbers, you can always insert a number using a 0.1, 511.1, 511.2 for different plants, different shifts, or put a letter in there for PA, for Pennsylvania, or NJ, New Jersey, as I explained earlier. The third thing I sent you in the second email that I forgot is, it's entitled, the file is 2-column paper, which is a misnomer because there's actually 5 columns there. This is general journal paper, okay? So the first column, as you can see, is headed for the date, or called the date column. The big column is for the name of the accounts that are going to be debited and credited. This little skinny column here, I have an asterisk up there because I didn't have enough room. If you look down the bottom of the page, that's a column called the posting reference column. And that's where, when we take the information from the general journal and put it into the specific general ledger accounts, we're going to use the account code, account number, to put in the posting reference column, and that signifies that, we did it. And also, if the phone rings or if you have a fire drill, you come back and you can see where you left off. This column says debit, this column says credit. This is where the numbers go, and it's going to correspond to the account being debited or the account being credited. I don't know if on the last video if I talked about what an account is. An account is merely a storage place where we put information, we put it in, and sometimes we'll take it out. And that's how we are going to use the debit and credit. That little 3x5 note card that I advised you to make up, or that I showed on a piece of paper with the normal balances of accounts. I can't find mine here, so I'm going to redo it when we get there. And I said normal balance, and down the left side we have asset, expense, and dividends, and on the right side we have liabilities, revenue, and equities. Those are what we need to know with chapter 2 addresses, and they give you account by account. They give you 12 different things to memorize. I rather, you want to do that, fine. Here you only have 6, and you know what the normal balances are. Logic will tell you, those are how you increase those types of accounts. So how would you decrease them? You would do the opposite of their normal balance. And keep this handy. While you're doing it, it'll help you early on, and after a while, you'll have these things ingrained in your brain, like they are in mine, through repetition, doing it over and over again. All right, let me move the keyboard up here a little bit to give myself some working room, push my computer back, and hope it doesn't fall off the desk. And what we're going to do today is we're going to continue with the evolution of smart touch learning. And we did the first 9 transactions that appear in chapter 2 are identical the first to the ones we saw in chapter 1. So I have those on another piece of paper here, and no need to repeat those. I just did them on regular binder paper. So now we're going to start off with transaction. My other computer over here just went blank. All right, I got it back up. After it sits for a while without being bothered, this battery saves and the screen goes blank. I just had to tap it. So we're going to go. It's not necessary, but I'm going to put over here in the margin the transaction and circle it, and then I'll put the dates in. And we'll go through this process, walk you through it. So we're starting with transaction 10. I'm just going to put on here. Transaction number. Just for your reference. Yeah, get this out of the way. All right. So on December 1, Smart Touch Learning prepays 3 months office rent of $3,000, $1,000 per month times 3 months. Now, we paid rent. I forgot on whatever transaction. One of the first 9 transactions was somewhere around 5 or 6, I think. And that was currently. Here, when we pay it in advance, it is an asset. It is not an expense because we haven't used it. And an expense, so you'll see in chapter 3, we'll talk more about this. When you have something that is available for you to use and you own it, it's an asset. It's a resource. As you start using some of it, it gets the asset goes down and it gets transferred to an expense account. And that's very important because assets are reported on the balance sheet. Expenses are reported on the income statement. And again, bear with me here. In the near future, we will see why that is and why it's so important. So now all we're trying to do here is get an understanding of recording transactions. And again, go back to the definition of accounting. We're doing the collecting and recording of the information, and then we're going to, by writing it in a journal entry. A journal entry is the only way you can put something into an account or take something out of an account. The only way you can change an account, increase or decrease it, is by writing a journal entry. Journal entries are the first thing we do. The general journal is often called the book of original entry because of that. All right. As I said in the previous video lecture, the general journal, the only order in the general journal is chronologic order. As the transactions occur, they get recorded. The accounts are helter-skelter all over the chart of accounts, all over the general ledger. So what we're going to do in the second part of the definition processing is we're going to take the journal entries and post them to the general ledger, which is going to summarize them. And you'll see how that works in a little bit. Actually, I think we did it last with the first 9 transactions in chapter 1, where we took those 9 journal entries, posted it to the T accounts, and then made a trial balance up. That's the processing part. And then from that, we did the financial statements. We're going to do the same thing here once we get these other, 10 or so journal entries. So we put the date up, the year up the top here. They're using, I believe, 2024. They don't tell you the year, but the financial statements. So all I do is write the year up the top of that date column, and then I'm going to put in December 1 for transaction 10. And now I already read it, and it says, prepay 6 months office rent. You see the word rent, you think right away it's an expense, but when you see the word prepaid in front of something, usually an expense type of an account, guaranteed that's an asset because it's prepaid. Okay, so an asset is being increased, prepaid rent. How did we pay it? With cash. So the asset cash has a normal debit balance. It's getting decreased, so we're going to credit cash. So this entry is going to be a debit to prepaid rent, increasing the asset called prepaid rent, and a credit to the asset account called cash. So we're going to debit cash. And I hope I mentioned it in the last lecture. The account or accounts being debited are always written above at the top of the journal entry. Any account being credited is written immediately below it, but indented. So we're crediting cash. So I will write the name of the account being credited. Cash is an asset, so to decrease it, I'm going to credit it. Now I just have to put the numbers in. And it said it was $3,000. And as always, the total of the credits and the total of the debits have to be equal. So there's the journal entry. In the book, in the little tan boxes for it, they show a little explanation underneath it. It said, paid rent in advance. Yeah, I think that's kind of redundant. Maybe because I've been at this for so long and I understand it's reasonably well. If I see prepaid rent, I know it's an asset. I see cash getting credited. So I see the asset prepaid rent going up with the debit, see the asset cash going down with the credit. I can look at that and I can pretty much figure out that explanation in my head that, hey, they paid rent in advance. Yeah. Duh. Let's see. Oops, come on. All right. Now, right under there, in the text, they're showing you what the T accounts look like after these things. We're going to rebuild those in a little bit. So now we come to transaction 11. Whenever you're writing journal entries, I always skip a line between one journal entry and the next one. It just sets it out better, makes it easier to the eye, easier to work with, and easier for anyone who's going to come and look at it. Now it says also on December 1. So I don't have to repeat the date. Once a date's in there, it's understood that it's repeated until we see a different date. Why do work if you don't have to? Unnecessary work. So transaction 11, payment of expense with cash. On December 1, Smart Touch Learning paid employee salaries of $1,200. Salaries expense will be debited to record the increase and cash will be credited for the decrease. Yeah, well, that's, I understand that. You guys are hopefully starting to get familiar with it. Also to the right of the little tan box, they're showing you the effect on the accounting equation of what's going on there, okay? So I'm just trying to analyze it to get you into the way I think about these things. We're paying employees salaries. Salaries is an expense account, has a normal debit balance, so it's going to be, and it's being increased. We're incurring an expense, so we're going to debit the expense called salaries expense for $1,200, and we're going to credit the asset cash for $1,200. And you can look at here or look in the book, and that's the exact same thing. A debit to increase the salaries expense account, and a credit of $1,200 to decrease the cash account. So we move on to transaction number 12. Let me scroll down here. You can see what they say. Once again, they show you underneath the effect in real time of posting those amounts. That is shown in the blue ink, that transaction we just did. And the black is all the transactions that occurred previously. Transaction 12, we purchase a building with note payable. Well, they're telling you what to do. Yeah, note payable is another term for a mortgage, okay? On December 1, again, busy day December 1 for Smart Touch Learning, they purchased a $60,000 building in exchange for a note payable. What that means is they went to the bank, got a mortgage, signed a note, signed a piece of paper promising to pay $60,000 with interest over, it's commercial loans, mortgages are usually 15 years. So they did all that. The bank then gives them $60,000, to which they deposit in their checking account. And no, they don't. They just had the note payable here. Okay, so they don't show the ins and outs of it. So we get the building. It's an asset, so it gets increased with the debit of $60,000. And we took on a liability, a note payable. It's a liability. The word payable, a word followed by the word payable, always going to be a liability. And that's also going to be for $60,000. Transaction 13. This is a little bit different one. It's kind of neat. Broaden our understanding on our horizons. On December 2nd, so I'm going to write 2 in that box for the date. December 2nd, that's the date column. I've got the year up here, I've got the month up here. All I need is the date. Smart Touch Learning received a contribution of furniture with a fair market value of $18,000 from Sheena Bright. Remember, Sheena Bright is the lady that owns it, the sole stockholder of Smart Touch Learning. In exchange, Smart Touch Learning issued her common stock. When she started the company, in transaction 1, she gave them cash of $30,000. Now she's giving other assets in the form of furniture. Well, that's going to increase her investment. It's a contribution from the owner to the corporation. So we're going to pick up the assets at their fair market value and issue her stock in exchange for contribution. So the asset furniture is going to be increased with a debit of $18,000. And common stock and equity account is also going to be increased, but with a credit of $18,000. I'm just going to, I don't know if this affects everything, but I'm turning up my microphone. All right. Next transaction was 14. Skip the line. And accrued liability, December 15th. So I'm going to put 15 in the date column. Smart Touch Learning received a telephone bill for $100 and will pay this expense next month. We'll talk more about these in Chapter 3, accrued expenses, accrued revenues, deferred expenses, deferred revenues. But again, that's a few weeks down the road. Telephone bill. We use the phone, and after usually a month, just like you do at home with your personal cell phone or landline, you will get a bill for your basic charges and any other fees, long distance calls or any other features you may have on it, call waiting, call forwarding, the voicemail, all that kind of good stuff the phone company will bill you for. You've used these things already. Okay, so you have incurred the expense, but you haven't recorded it yet. Nor are you going to pay it, because when you get the bill, it says the bill is due at some future point in time. Well, for cash flow purposes, why pay it now? Pay it when it's due. Keep that money around as long as you can. So it's an expense. We're going to call it utilities expense. So it's getting increased. So we're going to debit the account called utilities expense. And we're not paying cash until January next month. We're in December. So we're going to say we're going to owe the telephone company that amount, that $100. So we're going to call it utilities payable. We're going to create a liability account for when we do actually pay the bill. We have a contract when we started the phone service. We will use your phone service, and you will bill us after we, every month, every third day, whatever the billing cycle is. You will send us a bill, and then give us a portion of time frame to which to pay it. We've already used that phone service, and we're going to pay for it in the future. So we promised, as part of the contract, promise to pay upon receipt of the bill, not at the time of the bill, not up front. So we're going to be paying afterwards. So utilities payable is a liability account and gets a credit to increase it. And it looks like that. In my handwriting, the book is a lot nicer because it's typed. And that's in the tan box under transaction 14. Transaction 15. Payment of expense with cash. On December 15th, Smart Touch paid employee salaries of $1,200. Salaries. Again, we've seen this, the third time we're paying employees. We don't have to put the date in because it's the same date as of transaction 14. So it's understood, it carries down. And again, the salaries expense is being increased. Normal balance of an expense account is a debit. So we're going to debit salaries expense. And we are going to reduce cash. Cash is an asset. So to reduce it, we have to credit it. And that's what it looks like, same as in the book, except I don't have the explanation there because it's self-explanatory. And how I'm doing this, because I've been doing it so long, on that basis of that T account we set up with the normal balances, I'm identifying the account, figuring out whether it's increasing or decreasing, and then whether I have to debit or credit it, depending on the type of account it is. Once again, as a review, debit and credit only mean left or right side of an account. They does not mean it's increasing or decreasing. Whether it's increasing or decreasing depends on what type of an account it is. All right, can't stress that enough, so I'm going to repeat it. I've just repeated it. I'll probably repeat it several times before the semester is over. Especially more so early on here to drill it into our brains. Transaction 16. Unearned revenue. On December 21, so the date is changing, so I'm going to put 21 in the date column. It's still December, and it's still 2024. A law firm engages Smart Touch Learning to provide e-learning services and agrees to pay $600 in advance. Deferred revenue. And don't worry about what it's called until Chapter 3. This is the opposite of the phone bill. We use the phone bill, get billed for it, and we'll pay for it in January. Here, we are not dealing with an expense, but a revenue account, except we haven't done anything yet to earn that revenue. But we've been paid. We've been paid before we deliver the goods or services. Now, it says unearned revenue. Whenever you see the word unearned in front of something, usually a revenue sounding type of account, guaranteed that's a liability. Why? Think about it. Somebody pays us, and we haven't done anything yet. We haven't delivered. So what are we, have we earned anything? No, the earning process has not begun, let alone finished. But we've gotten paid. So we have an obligation. It's a contract. It may not be a written contract, but they're paying us in good faith to provide services to their employees next week, next month, whenever, sometime in the future. So we've got their money. We are now obligated to either provide the training, and if we don't, return them their money. So it's an obligation. Obligation is another word for a liability. We owe them the training. We have to provide the training to their employees. And if not, give them their money back, refund them their money. So we get cash. Cash is an asset, gets increased with the debit, $600. And we're going to increase the liability account called unearned revenue. Unearned revenue, okay. I'm making sure they didn't call it unearned service revenue. Very important that we put it in the liability account because that puts it on the balance sheet, not on the income statement. It will not go on the income statement until we deliver the goods or services. Sorry, I hitting the table there and I got some vibration in the computer, so I probably kind of look worried like I'm not sick or anything. It was just vibration from me tapping the table. All right. Now they talk about Fry's Electronics. I don't know why they brought that in there. Transaction 17. Skip a line. Transaction 17. What's the date? The 28th of December. So it's different from the previous transaction recording. So I'll update the date. Earning of service revenue for cash on December 28th. Smart Touch Learning collected cash of $8,000 for service revenue that the business earned. It's very important that we pay attention to the tenses of the verb, current or past tense or future tense. So we have earned it. So once we have earned it, one of the criteria for recognizing revenue is that it has to be earned. You can't recognize it before it's earned. Before it's earned, it's a liability. Okay, if you were paid for it. So we did. This must have been simultaneously. So we did provide it because it says earned, and we collected cash. So cash as an asset gets increased with the debit. Service revenue is a revenue account. It gets increased with the credit. $8,000. And got to turn the page. Come on. Oh, come on. This thing will not advance on me. Oh, let's go back. Turn page 11. Come on. Please bear with me while I struggle with my trying to turn the page. Oh, come on. I'm skipping a bunch of pages in there. I'm going from page 11 to page 22. Transaction 4. Transaction 8. Maybe there's only 17 transactions. I guess so, maybe. I thought there were more. 16. No, I've got 17 here. Now I'm only looking at 16. Oh, the joys of this. Let me stop the tape so I don't waste time. Ah. Okay, maybe there's only 17 transactions. I hope so. We'll find out shortly when we do the posting. So I'm going to take one of my blank pages with all these T accounts, and I'm going to set them up for all those transactions we did with Smart Touch Learning. So the first account is going to be cash. And let me go to my chart of accounts here. And I will designate that as account number 111. Okay. Accounts receivable will be our next account. I'm just going to abbreviate capital A/capital R for accounts receivable. And according to our chart of accounts, that's 113. The next account would be assets office supplies. That would be account 116 per our chart of accounts. And I'm just going to keep on going through all these accounts until I get them all. And then we're going to go back and get these journal entries that we've done last video and this video and post them to the individual accounts in the general ledger, take their balances, and then prepare another trial balance, and then do a new set of financial statements. We did the ones after the first 9 transactions for the end of November. Now we're going to do it for the end of December. Prepaid rent is the next asset. And I have the chart of accounts has that as account 117. Land, account 141, the charts, and building. And that's account 142. And furniture. It's not on the chart of accounts, so maybe we can call that account 150. You can always add something, but it's not on the chart of accounts, but I have to use a number that is one that hasn't been used. And furniture is an asset, so it still has to begin with a 1, okay? Furniture. Now we're going to do our liabilities. So the accounts payable, I'm just going to use the abbreviation capital A/capital P. And if I look, that would be account 212. And then we're going to have utilities payable. Now, I probably should have went in order and put note payable in there for the bank. Let me check, scribble out here. Just make me feel like a student here. I'm going to use the abbreviation NP for note payable. And so I put account payable, I see that I have note payable. The chart of accounts, the note payable should be farther down because we'll get into that later on. Then 212 would be the account payable. Sorry about that. I guess I should put this on a clipboard, make it a little bit more rigid. What else we have? Utilities payable. It's not in there. Our next one on our chart of accounts is unearned revenue 213, account number 213. And what do we have? I'm sorry, 213 is unearned revenue. Unearned revenue, we have utilities payable, which doesn't appear in our chart of accounts, so I can add it in. It's a liability, so it has to begin with the number 2. And I go to the chart of accounts to find one that's not used. I have 2, 11, 12, 13, 14, 15. So I'll call utilities account 216. Trying to keep them in order, numerical order. And also they're in order by type of account. So that's the end of the liabilities, I believe. 1, 2, 3, 4. 1, 2, 3, 4. Okay, so common stock comes next. And we're changing to an equity account, so that will be 311. And we're going to have dividends. Which is 315. And then we're going to have service revenue. We call it 411 here. It says sales or some type of revenue account, so we'll call it service revenue. And now we go with our expense accounts. So first one we have is wages and salaries, 511, or salaries expense. And I've used all 15, so I have to get myself another paper. And let's see, salaries and wages, utilities expense is in our chart of accounts at 512. So I will use that. And utilities, we've got utilities. What do we have here? Salary, rent expense, 514. So I hope I have all the accounts. If not, I can always insert one because I have a pen and I have paper and I have a brain. Okay, so now let me stop the tape and get my original 9 transactions. Or if you have the paper, if you did it, we can use that and just add to it. But I'm going to stop the tape and restart it once I get the numbers from the first 9 transactions posted. Okay, I'm back. Sorry for the interruption, but a whole bunch of papers there, and wouldn't you know, the one I'm looking for was the one on the bottom of the pile. Here's what we did last time. You can see the journal entries. I wrote them on a piece of paper. I also made the T accounts up. So what I'm going to do, while I was digging through these papers, I was thinking I had good practice if we take those journal entries, those first 9, and start out with because I'm thinking you guys, if you printed these forms out, you'd be blank. So we're going to take a couple minutes, 4 or 5 minutes at most, maybe, and get those journal entries from chapter 1 that are repeated in chapter 2 onto our blank piece of paper, so you don't have to get updated like I did. All right, so here's our first entry. Was cash to start the business. The $30,000 contributed by Sheena Bright. Cash comes into the Smart Touch Learning account. It's an asset, gets a debit, and credit common stock being issued to her. Now, I think I may have, hopefully I said it last video. When we have information in the transactions are being recorded in the general journal, we're going to transpose that information to the general ledger accounts. It's the same information. Now, you might think, well, why are we doing the same thing twice? Why not just put it in the general ledger accounts directly? Yeah, no, that's not the way it's done. This is to record them. This is to bring some order to the chaos here. The only thing we have here is chronological order. Here, we're going to get all that information. What's going to happen in the general ledger accounts, we're going to collect all the debits and credits that affect an individual account in one place. Here, we have it on 2 pages. The ones we did from chapter 1, the ones we did from chapter 2. So let's get cracking here. So we had the cash account getting a debit of $30,000. And you can put the date there, December 1. And the common stock account getting a credit of $30,000. One. So what I did, I took the debit from the journal, I put the date, and I took the credit from the journal for transaction 1, put the amount in, put the date. Now I'm going to, I don't have a posting reference column here, but it would be right to the left of the debit column. If I have my big ruler, which I don't here, I'll write it in. So the cash account is 111. The common stock account is 311. So there's my posting references right there. That means it's in the general ledger. Transaction number 2, the land account was debited for $20,000. And that was, don't have the date on that. Handy. November 2nd. Oh, I'm sorry, yeah. That should be November 1st for that cash coming in and the common stock. I forgot. I'm thinking chapter 2 of the December transactions. So here's the posting for the land account, November 2nd, $20,000. Cash, November 2nd, $20,000. Now I'll cross-reference that with the journal entry using the account codes, so I know that they're posted. Everything is cross-referenced. Land is account 141. Cash is account 111. I'm going to sneeze. So right here I have it. That signifies that I posted it. Oh, excuse me. Oh, thank you. Transaction number 3. Office supplies were increased with a $500 debit because we got them from the office supplies on credit. So accounts payable is going to be increased with a credit of $500 also on November 3. Where's the office supplies? Office supplies up here, November 3, $500. Accounts payable, credit, $300. If it's a debit in the journal, it's going to be a debit in the ledger. If it's a credit in the journal, it's going to be a credit in the ledger. What do I have to do? We have to do our posting references to the journal entries for the office supplies, account 116, and accounts payable, account 212. $16 and $212 accounts payable, office supplies. Transaction number 4, we received cash for performing service revenue to clients, $5,500 on November 8th. Service revenue 411 gets a credit of $5,500 November 8th, and it's 411. So from the journal entry, I got a debit to cash on November 8th, and service revenue gets a credit on November 8th for $5,500. Cross-reference the account number to the general journal to signify that it has been posted. Put these on clipboards. Make it. I had another one. There it is. Okay, transaction number 5. Accounts receivable gets a $3,000 debit on November 10th. And I'll put in account 113 as my posting reference on the journal. And service revenue gets another credit, $3,000. And that's on the 10th as well. So I took the information from that transaction. Accounts receivable gets a $3,000. And the service revenue gets $3,000 on November 10th. I take those account numbers, 411. Accounts receivable, what's that, 113. Service revenue, 411, right there. And I'm going to go to the next one, our first compound entry, office rent, the expense. That is on page 2 of my general ledger, on my clipboard. $2,000 debit on November 15th. 514 is the code for the account. Salaries expense, $1,200 debit, also on the 15th, and that's 511. And a $3,200 credit to cash, and that would be 111. So the expense account rent gets a debit on the 15th. I posted it, so I put the account code for rent expense, office rent. Same thing for the salaries and also for the cash. Let me now go to again, lost my place a little bit, but I can look at my general journal. I see the last one I posted was transaction 6, so I now go down to 7. The beauty of having posting references. Accounts, we paid part of the office supplies we purchased off. So the account payable is a liability. It's getting decreased, so we have to debit it. It's a normal credit balance that increases it. So to decrease it, we have to do the opposite. So we'll put a debit in there on November 21. And we'll put the account code for accounts payable in the general journal. And I'm halfway through posting that thing. So if the phone rang or I got distracted, I would go back and say, hey, I only have half of it. I didn't post the second half of the entry. Phone rang or I got called away from my desk or, like I said, fire drill, whatever. So I'll come down now and post the credit to cash of $300 also on the 21st of November. And I'll put the account code for cash in transaction 7. Transaction 8, people that we did work for on account paid us partially. So $2,000 is coming into the cash account with a debit on November 22nd. And the accounts receivable is being reduced with a credit of $2,000 on November 22nd. So now I just put my posting references over here. Let me know that I've done those. I've got the posting references in. I've got the debit to cash and the credit to accounts receivable in the general ledger account. Transaction number 9, the dividends are increased by $5,000 on November 25th. I'll put the posting reference in the general journal and the credit to cash of $5,000, 11/25, and there I have posted the November transactions to the general ledger. When we get all done, I'll put this up and hold it up there for a while so you can correct yourself. It also appears in the textbook. Okay, starting off with the November transactions that we just went over. I'm going to post those. So the prepaid rent gets a $3,000 debit on December 1st. And I'll put the 117 in there. I've posted half of that transaction. Prepaid rent right there. Now I'm going to post the other half. Let's see. So that was a cash credit of $3,000. December 1. Salaries or wages and salaries expense goes up for $1,200 on December 1. Cash goes down $1,200 on December 1. I'm going to do all these. Let's see. Building goes $60,000 debit into the general ledger account called building on December 1. 142 is the account code for the posting reference. Note payable is a liability. That is a credit of $60,000 on December 1 also, 211. Furniture is contributed by the owner for $18,000 on December 2nd. Put the posting reference in there. Common stock was issued in exchange for it. There was a credit in the journal. It's a credit in the ledger, $18,000, 12/2. Common stock, 311. Utilities expense, got to flip back to page 2 for the utilities expense. Debit of $100 for the phone bill on December 15th. 512 is the account code. My posting reference in there. Utilities payables, a liability. Utilities payable. It's a credit for $100 on December 15th. 216 is the account code. Wages and salaries paid again, $1,200 on December 15th. Cash credited again. I'm running out of room on the cash account. Wrote too big. Cash goes up $600 for the payment received in advance from the law firm to give them training on the 21st. Unearned revenue, a liability account gets credited for the same amount on the same date. 12/21, 2/13. And finally, cash comes in of $8,000 for providing services to clients on the 28th. So all I did was go down this list, took all the account names, found them in the general ledger. If it was a debit, that account got debited. If it's a credited, that account got credited. Once I posted it, I put the account code in the posting reference column. And this is what I come up with. Let me put this up, and I'll hold it up there for a while. I guess you guys can always freeze the YouTube also. That's what the general journal looks like after we record the 17 transactions. Here's what the general ledger looks like. Come over to page 2. Now, the next thing we have to do is we have to go through the general ledger accounts, determine their balances, and then do the trial balance. Let me get this in here. So I have this in the book. So let me just make sure I got everything. 30,000, 5,500, 2,000, 6,000, 8,000, 20,000, 3,200, 300, 5,000, 3,000, 12, and 12. Yes. So the balance in the cash account is $12,200. Balance in the accounts receivable is $1,000. So all I did was add up all the debits and subtract out all the credits. You could add them up separately and pencil put them in. The difference there is $12,200 on the debit side. That's good. That means we have a positive balance in cash. Always a nice thing. The accounts receivable, we have, it's a little bit easier, not as much. You can obviously see cash is one of the most active, is the most active account there is. Accounts receivable, we originally booked $3,000. We received a $2,000 payment, which corresponds with that, $2,000 over here. So we have a balance of $1,000. The people that we did that work for, we got paid 2/3 of it. We still have $1,000 owed to us. The other ones with just one entry, you can just double underscore them because that's their balance. The next one, again, all these had only one entry. The next one with two entries was accounts payable. We incurred a $500 liability for the office supplies. We paid $300, so we still owe the office supplies. Who owes us and who we owe? Under revenue is easy. Utilities only one. Common stock, we had two entries. Total now invested by Miss Sheena Bright is $48,000. right? Her $30,000 cash investment and her $18,000 investment of furniture into the business, total $48,000. Dividends, only one. Service revenue, we have three, $5,500, $3,000, $8,000, it'll be $16,500. And wages, we have three payments of $1,200, would be $36 on the debit side. And let's see what we have here. The utilities expense for $100 and the rent expense for $2,000. And the two expense accounts on the next page. Okay, this was when we're taking that information from the general journal and putting it into the general ledger. That is the second part of our definition of accounting, the processing part. We're going to, and what happens there? We have the general journal entries that recorded the transactions, and the only order they have is chronological. The accounts are all over the place depending on what was happening in that transaction. We take that same information and put it into the general ledger accounts. Now we have all the transactions that affected cash, accounts receivable, common stock, revenue, salaries, expense, all neatly summarized, condensed. We can further condense it by doing a trial balance for December 30th, 2024. I'm just going to put STL up the top for Smart Touch Learning, abbreviating to save some time. And this is a trial balance. And it's for the month ended, maybe the year, probably. December 31, 2024. That's my heading. Yeah, it's not real pretty because I rushed it and I abbreviated. But again, don't want to bore you with a whole lot of stuff. Now, what a trial balance is just a listing of all the accounts with their balances that are in the general ledger. And what we do at this point in time, we only list the ones that have a balance other than zero. Now, there's one account here that should be here that's not here, and we'll do that after we do the financial statements. That is being an equity account called retained earnings. So we're going to have two columns. Let me draw a straight line down here. Probably longer than I needed it to be, but that's all right. It's going to be one side for the debits, one side for the credits, and over here is going to be the account names. Yeah, I may as well put those in. Okay. And I just go through the ledger in order, and you'll see when we get done how nice that order is. Cash, $12,200 balance. Accounts receivable, I'm going to abbreviate it to save time. $1,000 debit. Office supplies, you wouldn't do this on a formal, if I had time, I would write everything out, but I'm going to abbreviate. Office supplies, $500. Prepaid rent, $3,000. Land, $20,000. Building, $60,000. Furniture, $18,000. Note payable, It's a credit for $60,000. Account payable, abbreviating to save time, $200 credit balance. Unearned revenue or liability, $600. Utilities payable, $100. Common stock, credit, $48,000. Dividends, be careful. Equity account, but it's a contra equity, has a $5,000 debit balance. Service revenue, going back to the credit balance side, $16,500. Salaries expense. I put wages down, so I scribbled it out. Just want to be consistent with the book. 3,600 debit balance. Okay, got to turn the page for the other two expense accounts. Utilities expense. $100 debit balance and rent expense. $2,000 debit balance. All right. Just going to throw a little thing at you. Don't get too shook up about it. But in chapter 3, we're going to talk about accruals and deferrals. As we went down this list, and notice that we had utilities expense listed there as an expense, $100 for the phone bill. We haven't paid it yet. We're not going to pay it until January. Regardless of when something is paid, we use what we call the accrual basis of accounting, not the cash basis of accounting, which means we're going to record revenues when they are earned, regardless of when payment is made, and expenses when incurred, regardless of when payment is made, or, with revenues be payment received. Okay, so that rent expense of, why do I have $2,000 there? Okay, yeah, that's what it was. Okay. Yeah, I guess we paid for, whatever, 2,000. November 15th. Paid for November and December, I guess. Yeah. So that rent expense is what we paid for November and December. The prepaid rent for $3,000 is for January, February, and March because we paid it in advance. Okay. Again, more on that on chapter 3. Just wanted to pop in my brain because some of you might say, well, why do we have that? We didn't pay for it yet. Well, nobody was incurred, a phone bill. All right, let me get my calculator out here. Let me have to go search for it. Wait. Happen to have one in the drawer. One over there on the table. Have them all over the house. All right, now let's add these up. 12,200 plus 23,000 plus 78,000 plus 600 plus 21. 25,400 I get there on the debit side. What do I get on the credit side? 60,000 plus 900. Wow, am I happy. Came out. Debits and credits are equal. Okay, so there is the trial balance. Where did I get this information? Right from the general ledger. All those T accounts, I just listed them in order with their respective balances, keeping track whether they're debits or credits. Add them all up, and you want those to agree all the time. Trial balance. It must balance. If it doesn't balance, means we made a mistake in posting. Now, if the does balance, it doesn't mean you did not make an error. All it means is that the total of the debits and the total of the credits are equal. And it's sort of a negative assurance that you're pretty good going forward from this point on. Let's see if there's anything on. Oh, okay. I'm trying to turn the page here in my electronic textbook. I go from page. Well, that's nice. I go from page 22 to page 21, and I was trying to go forward. The book talks about a 4-column paper. There's various ways. In accounting, we have 3-column paper for an account. We're using the T account, so it has a debit and a credit side, and we have to compute the balance. If you use 3-column paper, you'll have a debit column, a credit column, and the third column will be a running balance, so you don't have to do the math at the end of the period. Of course, the computers do the math for you now. They also have a 4-column paper they show you in the textbook, I guess to confuse people. So they have a debit column, a date, the item, posting reference, debit, credit column. Then they have the balance shown as a debit or credit. We can just have that 3-column paper and have the balance shown as a positive number if it's a normal balance. If it's in parentheses, it's the abnormal balance. Okay. Well, let's see what else is in the chapter here. They just explained some of the nuances of what we were doing there with the journal entries and the posting. And now I guess we can do the, let's see, they have a trial balance there in Exhibit 2-10, exactly what we just did. So that's kind of nice. It's better if you do it than read it. You can read it, but if you do it, you have a little bit more with you. It's getting ingrained within you a little bit better. You see in Exhibit 2-11, we see the 3 statements that we're going to be concerned with. Again, we're not going to be doing anything with the statement of cash flows this semester, although we have to know that it exists and be able to define it. In Exhibit 211, on page 2-24, they show you the income statement, the statement of retained earnings, and the balance sheet for Smart Touch Learning as of the end of 2024. Again, you have the heading there on all of them in the darker shaded box. The revenues, the income statement, again, has to be done first because we need the result of the income statement to do the statement of retained earnings. And all it does is list the revenues up the top. Revenues, they show service revenue, $16,500. Where did that number come from? Well, it came from the trial balance, which summarizes the general ledger, which summarizes the general journal. Okay, so those transactions get recorded, then they get summarized and posted, and then we prepare the trial balance, which is our document that summarizes everything on one nice, neat page and provides the information for the preparation of the financial statements. Since we set up the ledger, those T accounts, in order of our chart of accounts, look what we have. We have all the assets, all the liabilities, all the equity, all the revenues, and then all the expenses. It's in order. If we put the account codes in here, you would notice that these are all 1s, then all 2s, then 3s, and then 4, and then the expenses would be 5s. Yes, there's a reason things are set up the way they are, to try and make it easier when we prepare the financial statements. The second statement we prepare is the statement of retained earnings. What is that? The retained earnings at the beginning of the year for the 2 months ended December 31. So the business started on November 1st. Retained earnings were 0. It wasn't listed in the trial balance because it didn't have a balance. Not even listed in, it's listed in the chart of accounts. So for the net income that was $10,800. Take out the $5,000 dividends, and we get retained earnings at December 31, 2024 of $5,800. Okay, you can see that blue line from the connecting the income statement to the statement of retained earnings. If the income statement was a negative, if the expenses were greater than the revenues, that second line, instead of saying net income for the 2 months, it would say net loss for the 2 months, and it would be a negative amount. Now, the bottom one is the balance sheet, the third financial statement they show there. And again, this is a account format because they have the assets on the left side and the liabilities and stockholders' equity on the right side. Those, it's the accounting equation. Assets equal liability plus equity. So we list the assets, get them directly from the trial balance in order, add them up. We get $114,700. List the liabilities right from the trial balance in order. We get $60,900. Add up the stockholders' equity, which is a common stock of $48,000, and the retained earnings at December 31st, 2024, which we computed to be $5,800 in the statement of retained earnings. That comes down into the equity section of the balance sheet. And we get a total stockholders' equity of $53,800. Add that to the total liabilities of $60,900, and you can see that bottom line there, total liabilities and stockholders' equity, $114,700, which agrees with the total of the assets. That's why they call it a balance sheet. Must balance. I don't know what happens here. I somehow this thing is jumping 2 pages on me when I try to advance from page to page. All right. In the trial balance, a couple of hints they give you. If you do a trial balance that doesn't balance, well, it's not a trial balance. It's a trial imbalance. Take the difference and divide it by 2 and look for something, a transaction or a balance that is that number, and maybe you transposed it. Divide, if you have a difference, and if that doesn't solve it, divide the difference by 9. If it's evenly divisible by 9, it means that you transposed a number. Okay, that's what they give you in Rule 2. Divide the difference between the total debits and credits by 2, and then look for a transaction or a balance, account balance with that number. And then item 3 there, divide the out of balance amount by 9, and then look for a transposition error. Okay. As our authors are wont to do, they close out every chapter, or every chapter except one, with introducing us to a new financial ratio. The one they do at the end of chapter 2 is called the debt ratio, which is the total liabilities divided by the total assets. You can find those numbers on the balance sheet. I don't know why they don't use a Smart Touch Learning Company for this. They always bring in a company here, Kohl's Corporation. Okay, total liabilities, and again, these would be in millions of dollars. If you'll read that there under the Pearson Higher Ed website reference there. It says Kohl's reported, in parentheses, in millions of dollars. So it doesn't matter if you put another comma and put 3 zeros after those numbers, and the ratio would still come out to 0.557 or 55.7%. What that means is they have a debt ratio of more than half. So 55.7% of their assets are financed by borrowing or through incurring liabilities. Creditors have a claim on 55.7% of the company's assets. Stockholders, on the other hand, would have the complement of that, 1 minus the 55.7. So that would be 44.3. Okay, so equity, stockholders, 44.3% of the assets are financed by owners, by equity financing. And I don't know if that means the company has more debt than equity to finance their assets. Doesn't make a whole lot of investors or creditors happy when you get over half. Again, depending on the industry, that means that it is it says it's an indication of the risk of the company. Yeah. Remember the old biblical saying that neither a borrower nor lender be? Well, yeah, it's biblical. In business, you inevitably you're going to have to borrow money sometimes somewhere, even if it's short term. A lot of times it's long term. You saw Smart Touch Learning took a note payable of $60,000 to buy the building. Well, the building is going to be around for a while, and usually commercial mortgages are 15 years. Hopefully, they'll have the building for more than 15 years. And you pay month by month by month. You make a mortgage payment. Some of it reduces the principal, some of it is for interest payment. Well, if you have a lot of debt, the more debt you have, the weaker you are financially. It's common sense. Okay. Sometimes you can make a lot of money with the judicious use of debt. It's called leveraging. If you can get a higher return on the money you invest by the assets you're financing than the interest rate you're getting charged on a loan, then sometimes, most often, it behooves you to go into debt because you'll be able to generate enough money to pay off the debt and have some for your stockholders. All right, that concludes our conclusion of our discussions on chapters 1 and 2. Hope you enjoyed it. Hope you learned something from it. Try it yourself. I emailed you the forms. I'll be doing the next video will be just going over the assignments at the end of the chapters per the syllabus. And if you have any questions or something's troubling you or bothering you, drop me an email. I don't can't say I'm not constantly on my email, but I will try to get back to you within 24 or 36 hours. I had the unfortunate incident with a person yesterday. I spent about, they were live and I was live, and we're emailing back and forth trying to resolve something with the textbook. And I think it ran at least 45 minutes to an hour wasted. I finally got frustrated and said, here's my phone number, call me, and a 5-minute phone call straightened it out. But it still wasted nearly an hour of their time and my time. So again, drop an email. If I can explain it in an email, I will. If not, we might have to resort to using a phone call, exchanging phone numbers. Unfortunately, I'll give you my cell number when it comes up. I'll get your number. So if you want to retain your privacy or anonymity, use a payphone or use a friend's phone or somebody else's phone, not yours. All right. Enjoy what's left of your weekend. And if I were you, my advice would be to walk through the chapter with those transactions and see if you can duplicate what we did, and also attack the assignments at the end of chapters. And I'll be going over the solutions in the next video, and then you can check yourself and get some feedback that way. So again, enjoy what's left of your weekend.